Thanks very much, Roland, and hello, everybody. It's lovely to see so many familiar faces again. This is, I was trying to count the other night, and this is at least the fourth year, if not more than that, that I've had the pleasure of coming to this event and talking to all of you a little bit about what we do and a little bit about the world of litigation finance. So what I'm going to do tonight, because I know a number of you have heard this before, but at the same time, I know there are others of you who are new to this proposition. What I'm going to try to do is give a little bit of a truncated presentation and allow maybe a little bit more time than normal for Q&A, because I historically have had a lot of questions from this audience, and so I want to try and leave enough time for that to happen. You all have the slides, or if you don't have them at this moment, you'll have them afterwards. And the slides, along with the annual report that are available on our website, give a very comprehensive overview of the business. And so to the extent that I fail to, especially for those of you not terribly familiar with Burford and its story, to the extent that I fail to address for you some basics, I'd really encourage you to go and look at those things. And in particular, I'd commend to you the annual report, which we get a lot of compliments on for just its readability. I suppose the benefit, in one sense, of having a business that is run by lawyers is that we're willing to push the envelope a little bit in terms of what we know we're allowed to say, and not be quite so constrained as lots of public companies are about the way in which we communicate to investors. So please have a read, and if after that you have some questions that remain unanswered, don't hesitate to be in touch with us, and we'll be happy to get back to you. Before I talk about Burford, I need to just give you just a moment of context about the world in which we operate, which really has me starting by talking about law. And by way of my own personal background, I'm Canadian actually originally, but I've lived in New York for a very long time. I was a trial lawyer, a litigator at one of the large New York City law firms, and ultimately then the global general counsel of Time Warner, the media group, before doing a bunch of media things, business things before I founded Burford about 10 years ago. And the reason I need to start with law for you is just to set the stage for what we do. Because many of you have had occasion to work with or retain lawyers in your past life. And you know that the usual methodology for lawyers working is to charge you by the hour for their time, usually more than you would like to pay. And the reason that that's important is because in most jurisdictions, not, by the way, in the UK any longer, and I'll come back to that in a second, but in most jurisdictions, including large jurisdictions like the United States, law firms don't access the capital markets. So they don't have balance sheets, and they're not able on their own, according to their business model, to take very much risk. And the problem that creates for law, which is this enormous global industry, by various accounts, somewhere up to $800 billion a year of annual revenue, the problem that creates for law firms is that when clients would like a financial arrangement other than paying by the hour, law firms find it very difficult to engage in that kind of risk-based financial arrangement on their own. It doesn't suit their business model because they don't have access to capital sources to change. The footnote, by the way, about the UK is that the UK, for about a dozen years now, has allowed law firms to access the capital markets. And you may have seen a few flotations of relatively small law firms here in the UK. That being said, the reality when you look across the world of UK law firms, which include some of the largest law firms in the world, and the flotations of UK law firms, you see something very skinny indeed, which tells you that most law firms today still are hewing to that traditional business model, that cash-based, pay-by-the-hour business model. So the problematic dynamic that creates is, here, please take this one, I'm not going to use it again. The problematic dynamic that creates for clients, and Burford is a corporate client-based firm. We deal only with businesses and large dollar cases. We don't do individual litigation finance or consumer litigation finance. The problem that creates for corporate clients is that corporate clients are besieged with more cost. With litigation cost, with regulatory compliance cost. All of you have seen this happen over the last decade and more. And when I was Time Warner's general counsel, even though I thought I had a terrifically good set of ideas about how to spend more of the company's money, there was, for reasons that I don't fully understand, a certain reluctance on the part of the CFO to give me more of that money. He had this strange idea that it should go to movies and television shows instead of to my legal department. But what that does is it means that it's difficult for corporates and lawyers to come together. They're seeking two different things. Corporates are seeking multiple options. Law firms are not able to give it. And so what has emerged is an industry that provides capital into the legal industry mix, that stands in between corporate clients and law firms and provides some financing. And Burford is the market leader of that industry today. What does that mean in actual fact? What are we actually doing? What we're actually doing is we are making asset-based investments in claims. Now that sounds strange, but when you think about what a claim is, a litigation claim, an arbitration claim, it's just an effort to get money to move from one person to another. If I sue you, I'm trying to get you to pay me money. That's a receivable. It's complex, it's got risk and contingency associated with it, but it nonetheless is something financial that we can nonetheless go and structure a financing transaction around. And that's exactly what we do. We look at the underlying asset value of those claims, and we structure financing solutions around them. This is quite a large market. There are many, many, many claims in the world, as all of you know. And a lot of money changes hands because of the dispute process. And we actually are occupying really quite a small slice of that very large level of dispute and legal fee activity. And we have some slides later in the pack that I'm happy for you to look at yourself that give you some sense of the overall size of the various levels of legal activity, both legal fees, as I said, $600 or $800 billion a year, the underlying value of disputes and settlements, again, hundreds of billions of dollars a year, if not more than that. So you've got very large numbers in play here, and in many cases, our presence is not changing anything about the traditional way that business has been done. Lots of companies are still going about their business, paying their lawyers by the hour, and preserving that business model. But what we're doing is involving ourselves in a slice of that market, which has been growing. And the reason that it has been growing is because there is pent-up demand for capital and for these solutions. So I am going to show you a couple of slides. The slide that is up on the screen shows you effectively the past for Burford. Because the other thing all of you know just from living in the world about litigation is that it's not very speedy. And so when we make an investment decision, that obviously takes some amount of time to turn itself into some result. And so what you see here are the results of those investment decisions in general made quite some time ago. What you're seeing in our business is a fair bit of growth. And again, the reason for that growth is because law as an industry has embraced to some extent the availability of capital. You've gone from what is probably the largest industry in the world that didn't have any capital applied to it to having some green shoots of capital. And that's creating a fair bit of capital activity and a fair bit of demand and desire, and that's showing up in our numbers. And so what you see here are a collection of numbers around traditional metrics, income, profit after tax, cash generation. This is quite a cash generative business. Litigation, while it's not speedy, is also not endless. And so as you can see in the bottom right-hand corner graph, the weighted average duration of our portfolio hovers somewhere around 2 years. This isn't private equity that can take 5, 7, 9 years to mature, although some of our individual investments do. But on an average basis, litigation is resolving itself faster than that. And so as a result, we're generating, as you can see from the top right, we're generating quite a lot of cash every year that we can turn around and reinvest into new investments. Another nice aspect of this business as an investment proposition is that our cash flows are coming out of judicial and arbitral activities. Those things happen without any reference to either market conditions or economic activity. In other words, this is an uncorrelated business. Our income streams are uncorrelated to the market. which is obviously attractive, especially when you're thinking about where we are in the overall economic cycle. And the downside, of course, of having our cash flows come from judicial decisions is that you can't predict when judges are going to do whatever it is that they're going to do. And so that means there also is the ever-present risk here of earnings volatility. We could easily have a period of time where nothing much of anything happens. Nothing has changed with respect to the potential or the value or our optimism about our investment portfolio, but you could have a time when judges just don't do very much. And that could result in us having volatility of earnings, which is just a part of the nature of the litigation process. And the business produces desirable returns. The returns that you see here are portfolio level returns. Those are calculated on a cash in, cash out basis. There's no accounting in those. I'll show you some accounting numbers later. And we've historically generated IRRs on the portfolio that have been in the mid to high 20s, and returns on capital, simple returns on capital in the sort of the 60 to 80% range. That translates into a return on equity that has for the last little while been in the high 20s and into the 30s. So in other words, we're sort of feeling like a top quartile private equity firm. That's a little bit like the financial feeling here. That's effectively what we aspire to. And when we look at things like the way we structure the business and the way that we manage the capital structure, we clearly have ROE in mind as one of the things that we're solving for. I focus, frankly, more on ROE and on shareholder return because I, like a number of you, are fundamentally getting my value from my shares in this business. I'm focused on shareholder value and ROE more than I am on any individual component of the business's activity. So if that's the past, this slide is effectively the future. And what that means is this is the new business that we're writing on an annual basis, with the expectation that that business, as it wends its way through the legal process, will ultimately in the future turn into some gains and some expected profitability. And as you can see, the level of demand for our capital has been going up, which has permitted us in the last couple of years to write significantly more business than we have in the past. The first step is writing the business. The next step is putting the capital out the door in response to that written business, and that is the left and the right-hand side of these charts simultaneously. The other thing that is going on in this industry, and it's going on with a fair bit of speed, is the evolution of our business. When we started 10 years ago, and this is our 10th anniversary this year, this was a pretty simple, basic business. We offered litigation funding. We said basically to you, if you have a claim and you don't want to pay the legal fees, we'll step in and pay the legal fees on your behalf, and we'll take a portion of the recovery. That was the basic business proposition. We still offer that, and that for many people is the entry-level product into this business. But as client demand has increased and as sophistication and awareness of the opportunities here has increased, we have expanded what we do into a variety of other things that meet the needs of our clients. And we can talk in depth about any of those options as we spend some more time together. And this is simply a granular look at how those various kinds of business have evolved. And if you look at where the capital is that we're deploying today, what you'll see from that is single case capital, that idea of basic litigation funding where our returns are coming from one single piece of litigation or arbitration. That's a significant part of our business, but it's also not nearly as large as portfolio financing, where we are now going to companies and to law firms and we're doing pools of their cases instead of a single case. That has very significant benefits for us in terms of reduced levels of losses because we're not taking the risk on just one case outcome. And it also creates a good deal of efficiency for us in terms of being able to write more business and do more deals. And then the other things that the business is expanding into, which are obviously smaller parts of what we do. We finance ourselves with a flexible capital structure. We traditionally were a balance sheet investor. We raised public equity and then public debt. We've been raising public debt serially since 2014. And we would take that capital, we would invest it directly off our balance sheet, along with reinvesting the capital that we get back from successful investments. By the time we got to 2016, we were seeing more growth than we believed we could satisfactorily accommodate on the balance sheet. And because of the potential volatility of cash flows that I mentioned earlier, we're a little bit shy about putting too much leverage on this business. The business has never had more than about 0.45 times leverage, so well less than half a turn of leverage. Right now, it's even lower than that. But we're not a big fan of really levering this business up, even though you could make the argument that that's a way of enhancing returns. So what we did instead in 2016 is we added a fund management business to what we do. And so in addition to direct investing, we also take in capital from institutional investors in classic 2 and 20 style funds, and we invest that incremental capital as well, side by side with the balance sheet investing that we're doing. In the fourth quarter of last year, we went on and raised a new fund, a new $300 million private fund, because we had filled up the old one. We had very significant demand for that fund, and we capped it at $300 million. The reason that we did that is because at the same time, we did a new investment transaction with a large sovereign wealth fund. And what we did there is quite interesting, and I'm pleased with its ability to bridge the economics between leverage on the one hand and private funds on the other. Because at the end of the day, while being a private fund manager is nice, you are giving away a significant portion, a clear majority of the returns to the capital being provided there. And so if you're an equity shareholder, you sort of ask yourself, gee, am I giving up too much of the returns for the capital? So what we've done with this sovereign wealth fund arrangement is we've sort of bridged that gap, and we arranged a $1 billion path to investment where we put in a third of that money. The sovereign wealth fund puts in 2/3, but we, the balance sheet, and you, the shareholders, get 60% of the profits despite having only invested a third of the capital. And so effectively, that's a mixture of a fund structure with some structural leverage dynamics on top of it. And we're very pleased with the dynamic that we have there. So I have failed in my promise to you because I have only 3 minutes left in my formal presentation. So I am actually going to stop right here. And I'm going to take questions from you, realizing that I haven't done a good job of giving you a grand tour of the whole business. Sir.
Yeah, yes, I've actually got 2 separate questions. The first question relates to the research report that came out last week by Canaccord Genuity, where they questioned your return on invested capital at 85%. So just wondering if you had any comments upon that particular report and some of the sort of the research findings there. The second question I have is in relation to the listing of the company. Mm-hmm. So you're very much a US-based company where majority of the earnings are in the US, but you're listed in the UK and you're also listed on the AIM as well. So obviously that negates any liquidity. You know, at the moment, the UK market is suffering from the Brexit effect, where global investors are avoiding and shunning the UK market. So not only are they shunning the UK top 100, FTSE 250, they're also shunning the AIM as well. So liquidity is being affected in the AIM market. So it'd be nice to get your thoughts as to whether or not, number one, Burford should be listed on a UK stock exchange, and number two, is it better for Burford, for liquidity purposes, to be listed on a US stock exchange? So apologies for such a long-winded question. Great questions, thank you very much.
Let me take them in reverse order, and while I do that, if I could have the presentation slides put back up here, that would be useful to me. So markets first. You're right that we're AIM listed. We found that to be, we started in AIM, to be perfectly honest, not from some brilliant process of analysis and scientific deduction, but because it was 2009, the capital markets were in the shambles. We thought we had a good proposition and we were looking for a way to capitalize it, and AIM was an efficient vehicle for us to do. So, in all candor, I didn't sit there in 2009 and say, what happens in 10 years if we're the largest company on AIM and we have a multi-billion-dollar market cap? Is that the right choice? I'm not sure I would have done it differently at the time, because AIM is a very effective way of listing and capitalizing smaller companies, which is exactly what we were at the time. I don't actually agree, though, about the liquidity comments. So we actually spend a fair bit of time on investor relations and with institutional investors, which drive the liquidity profile of the company. You know, I've just come from spending the entire day, for example, at the Goldman Sachs Mid-Cap Conference, where I saw, I don't know how many institutional investors, 30, 40 in small group meetings. And if you look at Burford's liquidity, Burford has a liquidity profile that's entirely consistent with its market cap size, even if we were on the main market. So the advice from brokers and analysts is that we wouldn't get any liquidity benefit from changing markets. We just get a lot of cost. So I don't see any particular benefit for us, any particular reason, and neither do our advisors, in moving to the main market. To the extent that you call us an American company, I also sort of take a little bit of issue with that because Burford really started life in London. When I was doing this business, even before Burford existed, our client base was a London client base. And the reason for that, I think, is that London has been advanced compared to the United States in making use of capital in this industry. And even today, you would probably find a higher level of awareness among London lawyers than among, broadly speaking, American lawyers about the presence of litigation finance capital. In fact, if you're a London solicitor, this has advanced so much that you have an obligation to tell your clients when they sign up with you about the potential availability of litigation finance as a way of paying your fees. And there's certainly no such provision in the United States. So yes, we absolutely do a lot of business in the United States because it's the largest litigation market in the world. But if you look at the geographic split of our business, it's roughly equivalent to legal market size. So we're doing about half the business that we do in the US. We're doing about a quarter of it in the UK and Europe. And we're doing the remaining quarter sort of all over the rest of the world. And that's pretty roughly equivalent to where things come. But back to the exchange question, I think it's a fair point. And if we were to look at expanding our listing, I think we probably would, and we said this in the annual report, we probably would be likely to think about a dual listing with an American exchange in addition to retaining the AIM listing. But I don't see a particular reason to spend all of the money, which is expensive, by the way, and we're cheap, to go and just simply convert the AIM listing to a main market listing, because I don't think we'd get any particular benefit out of that. Now, you asked me also about the calculation of returns. So and let me just go through here quite quickly and find the slide I'm looking for. So this is in tiny type, and you're not going to be able to read it. And that's actually not why I've put it up to let you read it. But I've put it up to show you something about the way that we do this. So when you think about how we provide you with financial information, we do two separate things. The first thing that we do is obviously we give you audited IFRS compliant financial statements that are audited by Ernst & Young. Now, IFRS for financial businesses, whether they are stockbrokers that have mark-to-market portfolios or whether they're complicated financial businesses like Burford or a venture capital fund, are required under IFRS to mark their investments to market. And what that means is that we go through our investment portfolio every 6 months, and we look at all of our investments, and we apply a valuation policy to them, which is then audited by Ernst & Young, which involves their specialty valuations team and outside counsel. So it's quite a comprehensive process. But what that does is it does include what is effectively projected earnings. So we're looking at an investment that we've made, and we've invested, let's say, $10 million in it, and something objectively good or objectively bad has happened in the underlying court case. That objective event will cause a change in the valuation of the case, because what this whole fair valuing process tries to do is it tries to replicate what a third-party buyer of that asset would be willing to pay, which is easy if you're talking about a stock, and it's harder if you're talking about something that is illiquid and complex. But nonetheless, we do that, and we're very transparent about how we do it, what the mechanism is, and also how much of our income is composed of realized versus unrealized gains. And that's been a consistent number over the last several years. So that's sort of option A for looking at the company and analyzing it. However, I personally don't look all that hard when I run the business at the unrealized gain portion of our income because I can't spend it. It doesn't exist yet. And so we also provide very detailed cash-on-cash information to investors without fair value. And so we do these two separate things. So you can analyze the investment portfolio however you'd like. And not only do we produce this table, which is in our annual report in our slides, we actually take that table and we explode it out on our website so that you can see every single investment on an individual line item basis. You can see the financial consequences of that investment, how much capital we've put in, how much capital we've got back to date, and what the returns are. And that will let you make your choice about whether you'd like to analyze the business on whatever way you'd like. You can analyze it purely on concluded cases. You can analyze it by allocating capital to ongoing cases as well, which is what we do. And that's where we get the returns. So just to put that in context, and this is particularly germane when we have multi-case portfolios. So it's sort of like you buying 200 shares of stock in a company and selling 50 of them. When you think about your profit on the 50, you're going to say, what did I pay for the 200 shares? What's a quarter of that? Did I sell them for more or less than that price? That's how you're going to compute your gain on the 50 shares. That's what we do as well. What you don't do is you don't say, well, I bought 200 shares, I've only sold 50, but I'm going to look at the entire cost of the 200 to see if I made any money or not, because you still own the other 150. Applied to our business, what that means is that if we do a multi-case portfolio, which I showed you before is a big part of our business, if we do a multi-case portfolio and case number 1 resolves itself, it either wins or loses, we'll take whatever the allocated cost of case number 1 is, just like the 50 shares, and we'll compare it to whatever gain we made on case number 1, or whatever loss we made on case number 1. And that gain or loss will be part of our reported returns, even though the rest of the portfolio is still going on. So I'll give you a real life example of that. In 2017, the balance sheet invested $127 million in a large law firm portfolio. It's early days for that kind of investment yet. And so right now, only one matter, only $17 million worth of cost has resolved, and it resolved for $20 million. I'm rounding here, but so it was an okay but not particularly impressive return. We made about a 20% return on capital. So what we will do in these return numbers is we will show this as a partial realization, and the partial realization will put 17 million of cost in the denominator, and we'll put the 3 million of profit in the numerator, and that'll be added to our returns. The alternative approach that you're talking about wouldn't do that. It would put all 127 million in the denominator. And I just don't personally think that makes any sense at all, and it's not consistent with how the market in general allocates cost and profit. And by the way, any fund manager who bought multiple lots of stock would be running at a loss if you applied that methodology to them. So we do it this way, but we're transparent about how we do it, and all the data is available for people to do it however they'd like.
We're going to be short on time, so you have one more question, please.
I said I left time for lots of questions, sir.
Just to ask whether you'll be staying after this presentation.
I am afraid that I am not, because you know what? I bet none of you know this exciting fact. This is the inaugural London International Disputes Week. And that is, even though I really enjoy talking to all of you and my other shareholders, I also am trying very hard to do lots of business. And the London International Disputes Week, if any of you would like to come, it's really exciting. There are hundreds of lawyers here talking about all sorts of great topics, but we can now have one more, I'm sure.
We can have
that
one
was
more.
very short.
Gentleman at the back with the shirt, Chris.
This is what you get when you let lawyers run companies, because I was paid by the hour to talk, and so now my answers are too long and I've taken up all your time. Sir.
The economics of the sovereign wealth deal are fantastic. Is there a difference, though, in how it will produce cash for you, so the third you commit? And if there is, if it's slower, what does that mean for what you do elsewhere? Do you look for lower duration assets? or-
Great question. It is in fact faster than the 2 and 20 funds, because the 2 and 20 funds,
Balance sheet.
well, it's the same as our balance sheet. So 2 and 20 funds are European waterfall funds, which means we have to wait for the carried interest until after the fund's capital has been returned to its investors. Whereas on the balance sheet, we're obviously getting the capital back on a per case basis. When a case wins, we have the capital. And in the sovereign wealth deal, we're also getting the capital back on a per case basis. So yes, it's happening at the same time. And my time is up. I apologize. But thank you very much for your attention. I really appreciate it. And it was lovely to see so many of you again.
Crystal, thank you very much.